Hello everyone. Today I will continue with my series of startup investments. This is the series where you will get to know everything you need to know about raising capital for any startups that you are going to start. And today's video is about angel investors. There are many other names for angel investors. They can also be called as business angels, private investors, seed angels, and informal investors. Now, what did they do to deserve this kind of name? Why are they actually called angels? Don't worry, you will get to know about everything about them. First of all, who are the angel investors? Angel investors are people that are likely to invest in your business when it is in the beginning stage. These are wealthy individuals with a lot of money that are likely to help small businesses in their business ventures. Most of the time, these people are actually putting their own money to work so that they can also make a profit in the near future. Now, I have said that angel investors are usually individuals that like to invest into businesses. But nowadays, the definition has morphed a little bit. Angel investors can also be found as groups. A few wealthy individuals can come together who are like-minded and they are likely to invest in new business ventures that are right up their alley. Meaning, a group of people that are interested in tech are more likely to invest in tech-related startups. These people can either be wealthy individuals that are looking for an investment opportunity, or they can also be successful entrepreneurs who want to help new people in the same sector and give them the initial boost in their business. To be qualified as an angel investor, they have to have some set amount of income and assets. Startups often go for angel investors for the second stage of the business funding. That is the norm. If you don't know about the stages of investment funding, I have made a previous video where I discuss each of the stages of investment process and which type of investors to go for at which stage. Now back to angel investors. Startups usually go for angel investors for the second stage of investment funding, but you can always break any rules at any stage if you are bold enough and connected enough. Getting money from angel investors is a form of equity financing. The angel investors almost always invest for a portion of your company. They might ask for 10% of your company, or they might also ask for 50% of your company. They are very much likely to ask for some percentage of the company. In most of the cases, these angels are actually careful while investing their money in you. That is because the failure rates in startups are really high. And if you have been following my startup investment series, you already know that. But despite the process being hard, it is definitely better than getting investments through debt financing process. That is, investment through loans. Now, what are the things that the angel investors are going to look for before investing in your startup? Well, obviously they are going to look at the business you are proposing to them, but more importantly, they are going to look at the founder. That would be you. They are going to see either you and your founder team are committed to the business or not. They will assess whether you are well suited for running the business or not. They are going to see whether your business plan is clearly thought out or not, whether you have a minimum viable product or not. They will also see if there are people willing to buy your product from you or not. I already said, angel investors are not very likely to invest in the first stage of the investment funding process. They come at the second stage of the investment funding process, and at that stage, your business should have some people lined up to buy from you. They are definitely going to want to see the full market potential of your business. That is, how many people are the potential target market. They will also look at your readiness. That is, whether you are ready to launch your business in the next month, or are you just pitching to them and you will need 18 more months to get ready and start your business. What is ideal for these angel investors is a company that has already started doing its business in the market and people are interested in buying from that company. If a company like that goes in front of angel investors, the investors are likely to jump in to take a share of that business in exchange of their investment. Now, what are the things that you need to keep in mind before closing the deal with angel investor or a group of angel investors? Yes, you should not close the deal with any angel investors just because they are willing to pay you. You need to keep the following things I am going to say in your mind. First of all, when you are making the deal with an angel investor, you have to see beforehand what they are going to provide you for your business that is not money. Yes, money is important, but angel investors can expand your network exponentially. They can help you with their advice if they themselves are entrepreneurs that have experience in the sector you are doing your business in. Also, you should keep in mind that an angel investor can be so much more than just a source of money. A seasoned investor is likely to provide you guidance through the thick and thin of the business world. They can also offer valuable networking opportunities, which is always helpful. And they can also have connections that can help your business improve. Now, let me give an example. For example, an angel investor can have a good connection with a supplier. If the supplier has a good connection with the angel investor and the angel investor is investing in you, the supplier might be willing to provide their raw materials to you at a lower cost than others. That itself can be an unfair advantage for you in the market that will set you apart from your competition. And the lower price you provide to your customer is ultimately going to be your competitive advantage. And if you have been following my other series about strategic management, you know how much businesses love competitive advantage. In short, ask your angels what non-monetary values do they bring to the table apart from the money. You should also try to see beforehand whether the ideas you have about how to run your company clashes with whoever it is you are getting your money from. Since they are going to be a significant partner in the business, they can have a lot of power to direct the way the company operates as a whole. If you have disagreeing interests with your angel investors, you will be at risk of losing the way the company is run at the late stage of the business. And in extreme cases, you can also be kicked out of your own company. And that actually happens in the real world. Another thing is how much this person is going to be involved in your business. I already said that you should look for angel investors that are going to give you a lot more than just money. But you can let go of that depending on your goal. If you do not want the investor to interrupt with your business that much, you can try to look for angels that are less likely to scrutinize every single step of your business. Yes, there are angel investors that are just too rich and want a new investment opportunity. They will not look at how you are conducting your business as long as you are going to be a profitable investment for them. Finding people like these is rare, but it is possible. Then again, it depends on the fact that you can afford to let go of the non-monetary advantages that I have discussed before. You have to weigh in both of the options and set your goal about how you are going to conduct your business in the short term and in the long term. Now I believe I have said almost everything you need to know about angel investors. Let me just mention advantage and disadvantage clearly once again. First of all, getting investment from angel investors is definitely less risky than getting a loan. If the business fails, you do not need to pay back the amount of money you got. I mean, your business is not going to fail, of course. You already know so much about investment from watching my videos, and you will be watching my future videos about the startup investment series. You are not going to fail. But businesses do fail. And if they do, the money the angel investors pay the businesses is going to go down the drain. And that is where the disadvantage comes in. The angel investors also know about the potential of losing this amount of money. So, getting this money from angel investors is not going to be easy at all. And the biggest disadvantage is the one that I have already said in this video over and over again. That is, you are going to lose the full control of your own business. The angel investors can barge in anytime and tell you what to do with your business, your own business. But that is the cost of getting the money from these people. And with that, I would like to end the discussion for angel investors for today. If you have any questions, you can ask below. I will try my best to answer them. And if I cannot completely explain any question in the comment section below, I will definitely make a future video explaining whatever questions you have in your mind. This is definitely not the end of this video. That is because the Spanish word for walk is caminar, and the Spanish word for run is correr. And that is also the end of the bonus content. And with that, I would like to officially end this video. Thanks a lot for watching up until this point. If you are still watching, you might as well like this video, and you can also subscribe to this channel so that you can get notified from my future videos. And lastly, as always, I really hope you learned something new today.